to start the recording again here. Okay, we're going to do a quick lesson on the voting machine versus the weighing machine. If you haven't read the book Intelligent Investor, I would encourage you to do so. There's a YouTube link here for it. You can just Google it, and there's an audio book for it, right? Graham was Buffett's mentor and talks about how in the short run the market is a voting machine, but in the long run it's a weighing machine. What does it mean to be a weighing machine? It's just the temporary fluctuations of a voting machine. It's the temporary fluctuations of a company because of bias problems people have. When GME was shooting to the moon, was the valuations really worth that? Of course not, right? When you hear something and you sell out because you're afraid, well, that's emotions that rule, right? So emotions rule the voting machine. Now, what does it mean to be a weighing machine? Well, a weighing machine is more about the fundamentals of a company, right? The better companies win out in the long run because they're the ones bringing in money. So again, for those that don't know, my background is an entrepreneur. I started Subways, I started other franchises, I took over some failing sport clips, turned them around, was able to sell them for $4.5 million in 4 years. And the reason is because when I went in and took over the sport clips, they were losing, $30,000-$40,000 a month. And nobody's going to be willing to pay a lot of money for a company that's losing $30,000-$40,000 a month per store, right? And so what did I have to do? I had to go in there and I had to change around the culture. I had to change around everything to make it start making money, because that's ultimately what drives the market. People want to invest in companies that are making money. Now, logic rules the voting machine combined with proper forward projecting. One of the things, and probably the hardest thing to do, is to have proper forward projections, right? You can't go too far out because you just don't know what's going to be happening. In 5 years, who knows what's going to be happening? So in 2023, I did a full year outlook and I made a slide, right? And what companies were I targeting? So when we're getting this big pullback in the market, I didn't go over there and say, hey, let me find the next AMC, or let me find the next GME, or whatever. I said, let me find companies that have a history of making money, of good management. Apple, Microsoft, Amazon, Google, right? Crowd, PNW, Datadog, Cost, Netflix, right? The semiconductors and AMD and Nvidia, right? These are the big dogs that I was like, guys, this is a once in a, quote unquote, they say it all the time, but once in a generation opportunity to get prices on these stocks at these levels, right? Are you ever going to be able to buy Meta at $100 again? I don't know. So for me, what was I doing? Well, I was weighing things out. And literally in October, what I was saying is, 2 Octobers ago, we've reached a point in the S&P where we're down 25%. Historically, after the S&P goes down 25%, within a year, you're green almost all the time. There was one sample where you weren't. But in 2 years, you're green all the time. And in 5 years, you're heavy green. And so at that point, that's when I started investing and not trading. I started investing in those companies, right? Because I was weighing them. So think of the difference between voting machine and weighing machine, and trading and investing, okay? Now, if we were to look at Uber and Lyft, and we were to look at the profitability of these companies, well, why is Uber going up, right, giving us great returns over the last 2 years, and Lyft going down, right? They're down 66%. So Lyft has given us 92% returns, and Uber has given us 92% returns, and Lyft has given us negative 66. Well, why? What does it always come back to, guys? What do I say drives the markets? It's earnings. Uber is a profitable company. Lyft is not. Right? So where do we want to invest our money? We want to invest our money in profitable companies. And so one of the themes that I have for you guys this year is learn to enjoy the pain. Right? Learn to enjoy the pain. What I mean by that is when you are investing in good companies or you're buying good companies, when things get pulled back, when price goes down on a company that is good, that is profitable, what is happening to the value? What's happening to the value of a company when price goes down? Can anybody tell me? So if yeah, the value goes up, right? Because you're paying less for it, right? And so now that we've shot up and we've got PE ratios over 20 on the SPY, I'm like, hey guys, we might need a pause here. I don't know, maybe not. Maybe we need to get to 20.5 or 21. But I'm taking a pause here because we went from 17, which I thought was a buy, to 20 plus. Right? Well, if it comes back down to 17, guess what I'm going to do? I'm going to be like, oh, great. Okay, great. Now I can take another shot at it, right? So the lower price goes, the more valuable a company becomes if it's a good company. Don't love the pain on junk companies. Like if you bought into a pump and dump that some guru you followed said buy, and it's now lost 90% of its value, it's not where you need to learn to love the pain there. You're playing junk companies. And so this is why you see my master watch list always has good companies that I'm willing to trade. I'm not going to have junk companies on my master watch list. I just don't trade them. Okay? Now, if you look at Meta and Snap, right? Same idea. Snapchat, losing money. Meta, cash cow, right? It's the same idea. We are a weighing machine over the long term. Will there be moments where Snap outperforms Meta? Absolutely. But in the long run, we are a weighing machine. Now, again, trading versus investing. I do both, okay? But let me explain something to everybody here, just so you know. I'm going to put this as gently as possible. Investors love traders because investors use technical analysis to stop you out before we run it up. You know how you're like, man, how do they know where our stops are? Well, because we know how 90% of humans are going to act and where they're going to put their stops. And so last October, right, everybody was stopping out and it was the end of the world, right? It was the end of the world. We're going lower. The Qs are firing a weekly squeeze down, right? It's like, oh, it's over. We're going back down. It's over. And all the bears came out of the woodwork saying there could be another Black Monday in store, right? Oh, it's this, it's that. All these people came out screaming from the top of their lungs about how they were right about being a bear. Well, what did I say to do, right? I'm just going to whip through a couple here. I started a long-term position in GNRC. I bought some more Google. We'll add as it hits 121. I bought NVIDIA on the 400 breakdown. Do you see these dates? I'm buying these dips in strong names. This is all stuff that I was telling you guys in here. Right? Meta murdered. Right? Meta got murdered after earnings. I'm like, hey, I'm scooping it up. Why? Why was I doing this, guys? Knowing what you know about earnings, about weighing versus voting, what was the voting machine doing? The voting machine was saying go down. And what was I saying? And why? Okay? So the voting machine, remember this, and you know, I'll make reference to this. Mr. Market, right, the manic depressive who sells and sells at highs, buys at highs, sells at lows, freaks out, right? I was like, man, this is looking great. These things are still undervalued. We still haven't reached an area where it's valuable, right? And let me explain something to you. These charts did not look pretty, right? The charts at the time were extremely ugly, right? And so, this is Google dropping from right here at 140 all the way down to 120, right? And I'm like, hey, I'm buying it we'll add it to 121, 122 areas. I'm loading this up because of value. I'm not looking at this at technical analysis at all. Technical analysis has nothing to do with this at all. Zero. This has to do with value. Okay? Value. I am weighing this. Okay? Now, what happened here is they put out earnings, and the reason it dropped is because their cloud services sector missed. Like, I think it gained 2% and they were going for 3% or something like that. So everybody freaked out. The voting machine freaked out. But let me ask you a question. What if McDonald's came out and said, hey guys, we didn't sell as many salads last year as we thought we were going to sell, or last quarter? We were expected to sell 100 salads and we only sold, 70 salads. Is that going to cause you to sell McDonald's? Well, no. And this is the beauty of understanding humans and their reactions. This is why I come in here and I tell you guys, I love earnings season because people overreact and it's very visible. It happens so quick and you can make money and you can be right back to where you were very quickly, right? And literally, weighing machine versus voting machine, right? NVIDIA cracking 400. Well, what was that? That's literally a technical breakdown. So all the technical analysis traders were like, I'm out and I'm shorting NVIDIA, right? And now we're up at 700 plus, right? Technical analysis is put into place to get you to stop out so that the voting machine stops out so that the weighing machine can come in and buy these dips. See the stop out? Stop out right there. Technical, lower low. Let's stop everybody out, right? Let's stop everybody else. Right here. I literally bottom tick this thing. So one of the things I want you guys to understand is technical analysis is here because value investors, market makers, and everybody knows where we put our stops. Doesn't mean you can't trade technical analysis. You can still make money trading technical analysis. You can trade a lot, right? But it has nothing to do with value. This is something that you should print out and put it on your wall. Value is what you get, but price is what you pay. So, am I willing to pay a 20 forward PE on the SPY? For me, I'm not. Not right now. I'm not. Am I willing to buy it if it's at a 17? Yeah. I'm much more willing to buy it at a 17, right? And so on Netflix, right, we're up here at 560 and I'm buying at 350 and I took profits on part of this for $100. How many of you guys have ever taken a $100 profit on a $400 stock? Well, the reason that you probably haven't been able to do that is because you look at things from a voting perspective versus a weighing perspective. Okay? McDonald's has inelastic demand just like cigarettes and beer. And healthcare, right? And healthcare. So, now, the way that I trade, guys, is I trade technicals within value plays. So, for example, I find companies that are good, and if I can set up a technical play that allows me to add to a position that I have, like a company that I like that I'm long in, like Netflix or Amazon or Google or VFC or any company that I'm long in that I like, what I'm trying to do is I'm trying to scalp out a position. So maybe I'm just going to make these numbers up. Maybe I buy 10,000 shares within this zone. I'm going to sell 8,000 trying to scalp out an advantage for that 2,000 shares to take for the long hit. And my goal is to hold, 10 to 20% of this for the long term, because I believe in the long term we're going up because we're a good company, the market's pushing, right? So I take huge wins on 10 to 20% of my positions, and I use the 50 to 80% to scalp out, and all that is doing is allowing my lizard brain, my freak out brain, to be controlled. Okay? Does that make sense? Now, this is an example of AMC, which is the exact opposite, right? So 9/7/2021, guess what I was doing? I'm shorting the heck out of AMC. Why? Because the voting machine, you've had your day in the fun, you had your squeeze. We're going to start putting in lower highs and we're going down, right? So it happens both ways, overvalue and undervalue. Okay, so Matt C asked a question. What do you guys think the answer is? Somebody answer that for Matt C. His question is, D-Man, are you mainly using daily charts for long-term plays or weekly? You think daily? So there's actually two parts to this question. Um, so if I'm playing it as a long-term play and it's my initial value play, I'm not even using a chart. The chart means nothing. It doesn't mean anything. I'm not using any chart. What am I using? Yes, price. Price is all that matters. Price is what you pay. Value is what you get. So if I can find a stock at a price that I like, then I buy it. I don't care what the chart looks like. It doesn't matter, right? Now, after I have started buying and I'm trying to play technical analysis within the value play, right? So at that point, I'll use all of the charts. So for example, we've been kind of extended the past few weeks. What have I been telling you guys? I've been telling you guys, hey, use shorter time frame charts because that's going to keep you safe, right? That's going to keep you safe. Shorter time frame charts are going to keep you safe. But there's going to be times when you need to play a weekly. There's going to be times when you need to play a daily. But the value aspect of it, chart means nothing. When I'm playing the technicals and the edge within it, then it does. And I'll use all of them. I hope that makes sense. I hope that answers your question. Now, I just wanted to show you a couple things. NVIDIA joined the $1 trillion club and is now worth as much as the entire Chinese market. Right? Is this justified? Is this voting or is this weighing? Look at the fundamentals. What do you guys think? Do you think that that NVIDIA is worth the entire Chinese market? Right? Do you guys think that NVIDIA is worth the entire energy sector of the S&P? Do you guys think NVIDIA is worth more than Amazon? Right? Now, this is literally what the voting machine is telling us, right? That it is. Even though it only makes 12 billion, Amazon makes what, 145 billion? Hey, let me ask you a question. If you were going out and buying a company, so the way that I put it is, if I was going out and buying a Subway, and this Subway came to me and said, "Hey, we're making $12 billion, and I'm going to charge you the market cap of what Nvidia is right now, which is more than Amazon's. So you got to pay me 1.8 trillion, or I could buy a company that makes 145 billion, and I can pay less for it, right? Shoot, I'm going to buy that Subway that makes 145 billion, right?" So what's causing this drive up? It's forward looking. The market's forward looking, and what they're saying on Nvidia is, hey, you know what? We think they're going to take over the world with AI, blah 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 blah, and that's why we're willing to pay up for this, right? Who's right? Well, I think both are right, but I think we're getting a little extended and ahead of ourselves as of now. Yeah, I agree with you, Kevin from Reno. I agree. David, right? You can never trust it. You never know. Okay. Now let me show you guys something, which is pretty interesting. Okay. The stock is up about 1,700%. This was a few days ago, right? Like a week ago, so it was before that. But guess what else is up 1,700% on Nvidia? It's earnings estimates. So do you see the 1 year forward guidance from 115 to 20? Share price from 37 to 680. You see how the numbers match? Now let's go over Meta's. Meta's goes from 597 to 2255. That's a 278% increase. Well, guess what? Their stock went up 254%. Yeah, right, Carrie? It's crazy. Well, what about Amazon? Well, Amazon went from 16 cents to 398. That's a 2,500% increase, 2466. Well, guess what their share price has done? Oh, wow, it's 2,800%. Wow. Wow. Okay. So if Google went from 69 to 680, 885%, their price went from 1330 to 143. Oh, wow, 980%. Oh, man, there's such correlation here, right? Wow. So what is this telling us, guys? What drives the markets? What drives the markets? Microsoft went from 93 cents to 11.57. Share price went from 30 to 404. So, right, look at the percentages. 11.44, 12.24, right? Pretty close. Well, what about Netflix? You guys remember when Netflix was going out of business, right? 11 cents. Now it's $17.11. 14.889%. Share price 14.882%. Right? And so I want to beat this into your brain. Earnings drives the markets. Forward guidance drives the markets. This is the weighing machine. The weighing machine gets outruled many times by the voting machine in both directions. That is where I make my money. To the short side, to the long side. When we get too low, I buy it. When we get too high, I short it. The iron rule of the market is we're going to come back to the mean. This is the market. That's it. So when things start getting overpriced, I stop going long. I just stop. That's just what I do. Until there's hard data that tells me I should get long. If we start crushing earnings again and our forward guide increases, right? That's going to lower the P side because the E side goes up, right? And so our ratios will go down. Does that make sense? Does everybody understand kind of what's happening? Now, what is something that you guys know that I think is valuable right now? Everybody knows what's one company that I just love to death. I say it all the time. I don't know if I've ever seen a company this undervalued. Yeah, Baba, right? Everybody knows I love Baba. AMD, I think, is at valuation. It's pretty close to valuation at 170, 180. A little high. Let me show you something. You guys have seen this before. I've shared this in another slide. So from 2014 to 2022, Alibaba grew revenues 884%, cash flow 500%, earnings per share 500%, share price 0%. Someone has already suffered 7 years of massive business growth with no price appreciation. So if you go down and you look at all of Baba's numbers down here, look at this growth. So just like we were doing with the previous chart, right? Amazon, Meta, all of those. If you were to take February, right, 2015, you can see earnings 2.6 right here, right? Well, where are we now? 964. Share price then, 87.87. Share price here, 734. So if we apply that same math to the previous charts, what is the implied value of Baba? It's about $325. You did? You grew up with Value Line? Well, is Baba going to hit that 325? Are we going to get a 3-4x? I don't know. Are we going to be able to time it? I don't know. But I can tell you that earnings and weighing went out in the end. And they will eventually with Alibaba as well. Can I tell you it's going to happen next month? No. Can I tell you it's going to happen next year? No. I can't. But I can tell you that it's going to. Right? So do I buy options with this? Yeah, I do. I've got January 2025 options, but again, options are a very small percentage of what I'm doing. I'm just trying to get some leverage in there to leverage up some of my positions. But I know if I buy shares, right, I'm going to win out in the end. Because let me ask you guys a question. What is the average the S&P returns every year? What's the average the S&P returns every year? Eight to 9, 9, 10 to 12, right? So here, let's just say 10. Let's just say 10. If in the next 4 years, Alibaba reaches its implied fair value, what is my percentage going to be in the next 4 years if it hits it? What will my percentage be if Baba hits it? So, and I was buying it lower. I was buying it in the 60s, right? I'm going to get a 4x. I'm going to get a 3 or 4x, right? So what does that mean if it happens over 4 years? I'm going to get 100% return on average. So in 4 years, if I get a 4x, then I'm averaging 100% a year. How many of you guys will take making 100% a year? I'll take it. I love that. I love that math. Right? So again, playing the time arbitrage game is the way you win in the market. Right? Now, I can't tell you the timing it's going to happen. I'm just going to tell you it's going to happen. And if it takes 8 years, right, that's still 50% win, right? Now, again, it's anyway, I don't want to get into longer and longer and longer. But again, just remember, this is what drives the market. Now, Here's the question that I'm going to ask for you guys. All of these above companies that you see here had huge drawdowns, right? Now, during this time frame, Nvidia dropped 71%. Meta dropped 43% in 2018 and 77% in 2022. Amazon dropped 60% in 2022 and Google dropped 50% and Microsoft 43% and then 60%, right? Netflix dropped a whopping 80%. Now, how many of you guys would have been able to hold through that? Let's say you were a long-term trader. How many of you would have been able to hold through that? Well, the only people that were able to hold through this are people that were weighing versus voting. Now, what I like to do, right, because I know the voting machine exists, I know that once in 100-year events come along much closer together than once in 100 years, right? We had two big drawdowns in the last 4 years, so it's not like once in 100 years comes along once in 100 years, right? They're like, this is a once in 100-year event. Wait, didn't we just have one a couple years ago? So I've already had 5 once in 100-year events in my life, so I should be 500 years old, but it doesn't work that way. Knowing this, I sell as valuations get closer, and I keep some cash, like what I've done here right now in this moment, to be able to buy back good value companies. So an example of this is Meta. Meta, I literally bought and told you guys, just wait. So Meta, this is what was happening on Meta. Meta was getting crushed on earnings. And the reason is because Zuck was burning $12, $13 billion a quarter on the metaverse. And right here is when he came out and said, I'm done. I'm not burning that anymore. We're turning our company into the most efficient company in the world, and we're going to make the next year the year of efficiency. And that's what I needed to hear. And so I've made 400% in a year and a few months, right? So I'm weighing while others are voting, right? Now, the other thing that I want you to understand about how weighing goes, for you guys that have been with me for a while, what else do I look at besides the balance sheet, besides earnings? What's one thing that we need? Yeah, that you're gonna find all the cash. You definitely want to have cash, right? You want to outdo your debt. Yeah, quality CEO management. It's all about that, right? So a lot of the time, you'll see me buy companies like VFC because they're in the midst of changing management. They got a new CEO, a CEO that I can trust. They've got a story to show me that something's going to be different. So on Meta, what happened? Oh, okay. Mark Zuckerberg got the message and said, hey, the shareholders don't like what I'm doing. I'll change. Oh, you're changing? Great. Now I can invest in you. Right? PayPal recently got a new CEO. Right? We're changing things. Right? Baba, Jack Ma recently came back, right? And the government stopped fighting with them. So you need the good balance sheet and you need the story that goes along with it, right? And so within all of these, you need a good balance sheet, right? You need a good story, something to create the turnaround story. You want to create a high margin of safety. You want to find companies that have moats, absolutely, and this is how you find good companies and play them. Once you have good companies, then you can start playing them on a technical level, right? Is there any other companies that I believe are being voted down and weights will bring it back up like Baba? Yeah, PayPal, right? Implied fair value using those same metrics is literally $168.92. So we're due about $100, right? Now, because I've gotten such a good price on this, even if we don't hit that implied fair value, right? Even if we hit 120, I'm happy, right? And that's the margin of safety. Now, if you look at PayPal, this is a great example of voting versus weighing. Do you guys see all these things that are circled? Revenue increase 9%, 8%. Net revenue increase 9%. Operating income 39%. Operating margin expanded up 21.5%, 39 basis points. GAAP EPS up 61%. Net revenues up 8%. Do you guys see anything that is negative? Anything at all on PayPal? Right? It's all going up. It returned roughly $5 billion to stockholders, right? 70 more million shares of common stock, including 10 million shares, right? For $0.6 billion in quarter 4 2023. Like, everything's going up. Good job. Looks good. Okay, we're turning in the right direction. Well, guess what? They got a new CEO. So what is he going to do? What do you guys, for you guys that know me, what's the key to happiness? What do I always tell you the key to happiness is? The key to happiness is your wife. Yes. Yeah, Mark, it's low expectations, right? How many of you have gone to a movie thinking it's going to be horrible? And you're like, it's pretty good, right? But you go to a movie and you think it's going to be amazing, and you're like, man, that sucked, right? It's expectations. And so guess what? Guess what our new CEO does? He's like, guys, everything went up. We're going up in every direction. Everything's improving. It looks beautiful. But guess what? I'm lowering the guide. It's like, why are you lowering the guide? There's nothing on here that says you should lower guide, right? So it's like, okay, I get it. I see what you're doing. You're lowering expectations so that you can beat earnings and you can look like the hero because you're the new CEO. Hey, well played. And so people sell off. And that's why I always tell you guys, hey, give me a couple days to read through these earnings reports and figure out what is happening. Is this an overreaction or not? Exactly. It's called sandbagging. Yeah, he's the sandbagging in chief. That's what he is. So, again, the voters, in my opinion, see this and they sell it without looking into it and saying, there's no reason to do this. He's just sandbagging. Right? Like, look at this. It's all positive. Nothing's negative. Looks great. How do we know he's sandbagging? This is it. We know he's sandbagging because of this. Right? So, the intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. That's what we talked about earlier. So as PayPal goes down, it becomes less risky and gives me a bigger margin of safety. Now, why doesn't everyone do this? Well, the simple answer is they don't have the character for it. Sometimes these things work quickly. Sometimes it takes time. The weighing machine always wins. It's called discipline, patience, and emotional control. So I want to read this quote to you and everybody in here. If you have failed at investing so far, it's not because you're stupid. Because I'm not smart. I'm not a smart guy. Like, I'm smarter than, the average person in the world because I live in America. I've got education. But it's not like I'm Einstein. It's because, like Sir Isaac Newton said, you haven't developed the emotional discipline that successful investing requires. Right? In chapter 8, Graham describes how to enhance your intelligence by harnessing your emotions and refusing to stoop to the market's level of irrationality. So what have I done today, guys? Literally, what am I doing today? I think we're at an irrational point in the market. That's just what I believe. Maybe I'm wrong. And maybe if I can get some more data in the next couple days or next week or two that shows that I'm wrong, then I'll be like, okay, I can see what everybody else is seeing now. But as much as I wanted to buy, remember I wanted to buy Facebook? Let's see what Facebook did. Oh, look at that. Look at that. I said, man, I want to buy Facebook right here, right now. Oh, it looks beautiful. I'd have made $4 or $5. Man, if I would have bought 1,000 shares, I could make a couple grand. Ooh, I would have made a lot of money. It would have been great. Right? No, I don't care. I'm not playing this game with you right now. Right? Everything was telling me to buy this. It was all setting up perfectly. And it happened. But I'm just not playing this game. I'm not playing the irrationality right now. I played it to the long side and captured my wins and my gains. It's time for me to take a break, let the market rest, and tell me what's going to be happening going forward. Right? The weighing machine always wins. Remember, price is what you pay, but value is what you get. Technical analysis says buy when the stock goes up, sell when the stock goes down. You can make money doing that, but I want you to start looking at things from a value perspective. Okay? Here's another example of NVIDIA. NVIDIA market cap of all the energy sectors versus market cap of NVIDIA versus the profitability, 150 billion versus 19. Yeah, I would rather have the 150 billion, right? It's just crazy. And I can literally go through and show you all these companies that I was weighing, right? Remember? IWM, it's a weighing machine. Do you guys remember what I said to you guys when I bought the IWM down here? I said the IWM's at like 11 forward ratio, and the SPY's at I think it was at an 18. This is the biggest spread we've seen in like 30 years. I'm buying, right? So everything that I come back to is value. Buy, right? Buy. This is all value plays that I'm doing here, right? Because in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Remember this. Remember this is what drives the markets. Remember that paying on good companies is a good thing. It allows us to get in at better values. And what drives the markets is value. It's not technical analysis. It's not the voting machine. There's money to be made within that. But what really drives the market is this. And so sometimes you'll hear me say, hey, I'm buying this, no stop. Hey, I'm playing this as a value play. Or, hey, I'm playing this as a technical play. If it drops below this level, I'm out. Understand the difference between the two. Decide what you want to be and what you want to do. Do you want to be an investor? Do you want to be a trader? Do you want to be a combination of both like me? And then approach the market in those ways. Okay. Any questions on this? Tell us how to counter irrationality. The way that I do it, Tom, again, for you guys that don't know, my emotional side of me is dead. Just ask my wife, my psychiatrist, psychologist, life coach, that I meet with weekly, and meets with my wife. He tells me that at the age of 8, I shut off my emotional side because that's when I walked in and I found my father. He had committed suicide. And so for me, at that point, I shut off my emotional side. Maybe that helps in trading because I'm like a robot. My wife doesn't like it. It doesn't help in marriage. Maybe I've got an advantage there. I don't know. But for me, the irrationality of it is exactly that. You know what I mean? It's like, because it is irrational, it's like, no, I'm not I don't see it. I don't get it. It's I don't see the picture. I don't see what you're seeing. Um, so yeah, yeah, you survive through the suffering, right? Okay. Yeah, these are some of my long term plays. Excuse me. Right. Give me just one sec. I'm starting to choke over here. Yeah, Peter, that's good. That's a great question. um, so, any questions before I stop this recording? Do you have a ratio you use regarding your investing and your trading? I'm trying to work out a balance coming from an invest, and I'm guessing that's investing background. I do, Jeff, and what I can tell you is it's proprietary, right? But what I can tell you is I look much more at enterprise value. If you look at enterprise value versus the EBITDA, right? I think for me it gives me a better valuation of the company. Um, that to me is where my bread is buttered.